Let's take a look at the ratios in Chapter 10, including this one, times interest earned. This is a solvency ratio because it measures the ability of a company to survive over a long period of time. And if a company has a lot of debt and has to make a lot of interest payments, it may not be able to survive over a long period of time. So this ratio specifically measures a company's ability to make interest payments as they come due. To calculate it, we're going to take net income and add back interest expense and tax expense. So essentially what we're doing is figuring out what was our net income before we subtracted the interest expense and taxes. So if we add these expenses back into net income, we'll get this figure. Then we're going to take that numerator and divide by the amount of interest expense, and our answer will be equal to the number of times that amount of interest was earned. So for example, Toyota, if its net income in millions of dollars was 2,254, so that would be 2,254,000,000, and if its interest expense was 350 million and tax expense 2,150,000,000, here we've added back the interest and the tax expense to the net income number. So we're going to take this total of the net income without the taxes and interest subtracted and divide it by the amount of interest expense. So here we see that Toyota, its times interest earned ratio is 13.6. Now Chapter 10 also talks about a couple of ratios from earlier chapters, from Chapter 2, and you'll want to know these ratios for the next exam as well. The first is the debt to assets ratio, and this one's easy because you just take total debt, your total liabilities, and divide by your total assets. So the name of the ratio tells you how to calculate it. And then the last one that you'll want to know for the exam is the current ratio that we learned in Chapter 2. And that is calculated by putting current assets in the numerator and dividing by current liabilities. And remember, we express this ratio like this. Whatever your answer is, you put in the front, followed by a colon and the number 1. So if current assets are 200,000 and current liabilities are 100,000, the 200,000 divided by the 100,000 is 2, so we would write the answer 2 to 1. And the current ratio measures a company's ability to pay short-term debt, where remember, times interest earned was a solvency ratio, and it measured the ability of a company to survive over a long period of time.